Here will be a case study examining the varying performance of these ETFs during a given period of time. This will be a 5 to 6 month period in the year 2020, a very eventful time in the stock market. And we will start by looking at the major index ETFs first. Here at the beginning there is the Dow Jones Industrial Average, which is represented by the DIA ETF quite well, almost the exact same movements during this given period of time. These approximate time periods were chosen because in early 2020 there were drastic movements in the stock market, and that serves to highlight the major differences between these sectors of the stock market and their ETFs. And a fairly similar picture with the S&P 500 index. Again, it shows the high at the beginning of 2020 down to the major low at the end of March and the subsequent recovery heading towards the second half of the year in an approximate 4-month period. And just like the DIA ETF, the SPY ETF does a very good job of reflecting the exact same movements as the S&P 500 index it is designed to represent. Then there's the Nasdaq index with similar movements during that time. However, you will notice some slight variation. It drops slightly less and it rises much more during the subsequent recovery. As you may remember, the Nasdaq index and therefore the Nasdaq ETF QQQ is more tech oriented. So this time period in particular examines that with the strength of tech stocks during the 2020 time period, where even during the major drop at the start of the year, the overall tech sector fared quite well compared to the rest of the stock market. The previous 3 index ETFs looked at companies of major importance, as they are some of the largest companies on the stock market. However, when looking at the small cap index, there is a slight difference, but overall you can see some similar features, especially during the drop at the start of 2020. And once again, the IWM Russell 2000 ETF represents the underlying index quite well with almost the exact same movements. Naturally, the companies of smaller cap stocks will have fewer resources and have less investor support during major declines compared to large cap companies that make up the major stocks of the Dow, S&P 500, and Nasdaq. As a contrast, they can also present higher possibility for growth potential. Many of these aspects can be seen with the larger drop compared to the Dow, S&P 500, and Nasdaq, and the slightly higher recovery during the given 4-month period following the market low. Now, with a good outline of the average market performance during that time, we can now look at specific sectors, beginning with the XLY, XLK, XLF, and XLI ETFs, which are grouped together given their higher correlation to the broader stock market. The XLY ETF demonstrates the closer correlation of the consumer discretionary sector with the broader stock market. Overall, it drops about the same amount as the DIA, SPY, and QQQ ETFs during the early 2020 timeframe. Then it is clear during the recovery, the consumer discretionary sector did play a significant part in the rise back up, as it rose significantly more than most of the broad market. 2020 was also a very strong year for technology stocks, and overall we can see the close relationship to the broader markets with the movements on the chart here. By contrast, the weakness of financial stocks can be seen with the XLF financial sector ETF during 2020. According to the correlation table seen earlier, the XLF ETF would be similar to the XLK and XLY ETFs in terms of the closer correlation between the financial sector and the broader stock market. However, 2020 was a poor year for financial stocks, and that is reflected in their lesser performance compared to the technology and consumer discretionary sectors. As a result, the financial sector had a much greater role in the decline of the overall stock market during the beginning of 2020, and a much smaller part in the recovery back up towards the second half of the year. Next, the XLI Industrial Sector ETF shows somewhat of a more middle ground. The industrial sector was not as strong as the technology or the consumer discretionary sectors. However, it fared better than the financial sector, while at the same time showing closer performance to the broader stock market, similar to the S&P 500 and Dow. Then when looking back at the diagram, we see the healthcare sector is somewhat on its own, not quite like all the other sectors in terms of its relationship to the broader stock market. 2020 was no exception, as the healthcare sector showed an overall strong correlation to the stock market, but with some slightly unique performance. It fared quite well against the drop, similar to the technology sector, only dropping about 30%. However, during the subsequent uptrend, the healthcare sector was lagging behind the more dominant technology and consumer discretionary sectors. Next, we examine the correlation decreasing between the material sector, consumer staples sector, and the broader stock market. Since the material sector is also influenced by the price of resources, the performance displayed here is not out of the ordinary. The general correlation is still there to begin with. The materials sector also drops within the 30 to 40% range to begin the year. However, you'll notice that it reaches its absolute low slightly before most of the other charts a few days earlier. Then when it recovers from around the 3769 area, it makes a significant recovery in comparison to most of the other charts we've seen. In the same approximate 4-month period, XLB rises about 60% from the 3769 low, which is among the highest percentage gains from the absolute low we've seen on all these charts so far. And just in case you are wondering or forgot about percentages and proportions, the chart drops about 39% and rises 60%, because in the case of the drop, it is about 39% from the high near the $62 range. So about 39% of the $62 price was lost from the high to the low. Then when looking at the upside move, the chart goes from 37.69 at the low 4 months later approximately to $60.60. So that's a difference of $22.91. And $22.91 happens to be approximately 60.79% of $37.69. Just mentioning that in case you were wondering why these charts seem to be rising significantly more than they have been dropping in terms of the percentage. Then when looking at the consumer staples ETF, it is quite strong during the drop. It has dropped the least so far, only about 26.5%, whereas most of the other charts, as you remember, dropped 30 to 40% on average. That is quite normal, as the consumer staples sector has traditionally dropped much less during market downturns compared to the rest of the market. This is mainly because investors tend to go towards the consumer staples sector during times of market decline over many other sectors. But as a trade-off, as you can clearly notice, the consumer staples sector normally rises less when the market goes back on an uptrend. And similar to the healthcare sector, it is also quite normal for uptrends to be quite stable for the consumer staples sector. Then we end off with the energy and utility sectors, which have a far lower correlation to the broader stock market and the previous ETFs. But keep in mind, this lower correlation may not always be applicable, especially for stock markets in places that are more focused on the energy sector, and will therefore be more influenced by fluctuations in prices of energy such as gas and oil. The lower correlation really shows for the energy sector on this chart in the same approximate time period, where it is barely able to reach and sustain a halfway recovery from the steep drop. At first, the utility sector shows some approximation to the broader stock market. However, for most of the chart before and after the drop, it shows the normal sideways movement that is quite common for the utility sector. Because utility sector stocks are quite established, rapid change in the industry won't be as common as what would be seen with the technology or consumer discretionary sectors. That means generally lower growth potential, but as a bonus, that means it is usually more stable, especially in comparison to the energy and materials sectors, which have many more external influences. These are simply examples, and they display the general characteristics of the correlations between the various sectors and the broader stock market. In general, these correlations have held up in the long term. Of course, every situation and time period is unique. 2020 in particular was a stronger year for the technology sector and consumer discretionary sector, but that does not mean this will always be the case. For example, in a situation such as the stock market crash from 2000 to about 2003, the market was declining, and that was led mainly by technology stocks, while the broader stock market still fell during that same time period. It fell significantly less than the technology sector. And that just goes to show the dynamic nature of the stock market, and that there is never truly one consistent sector that is always good or bad at any given time. You can demonstrate this yourself by comparing an ETF with a broad market index, such as we did here with the XLK ETF and the S&P 500 ETF. Show one time period where your chosen ETF outperformed the market, such as XLK did in 2020. Then with the same ETF, find another time period where it underperformed the overall stock market, such as the case with XLK from about 2000 to the end of 2002.